Sir Howard, when did you start writing this? I mean, honestly, it comes at such an amazing time of crisis where people are looking for history and anything as a guide.
Yeah, well, it was a lockdown project. I felt guilty in the lockdown. I had to use somehow the time that I was saving. So I thought, well, maybe it would be a good point at which to reflect on the history of the last 25 years, which has been pretty exciting in the UK. We had the great financial crisis, we had Bank of England independence, we've had Brexit referendum, Scottish referendum. And I asked the various chancellors who'd served through this period if they were prepared to reflect on it. And of course, they had time on their hands as well. So in fact, they were very happy to talk to me about it, as indeed were quite a lot of officials. So what I've tried to do is to tell the story of the last 25 years as seen from the Treasury, which turns out now to be quite a relevant thing, I think.
Sir Howard, we were talking earlier this week about how the Bank of England raised rates because they were concerned. They raised rates only 25 basis points because they were more concerned about the labor market softening or perhaps consumer demand getting crimped in discretionary spending than they were about the inflationary inputs that continue to create huge pressures on the economy. Was that the right move based on all of those conversations you had?
Well, I think I was with the three in the minority. I mean, it was a 6-3 vote on the Monetary Policy Committee. Interestingly, of the four external economists, 3 voted for a 50 basis point rise and 1 voted with the Bank of England insiders for the 25% rise. And I was with the 3 out of the 4 externals, I have to say, because I think one of the problems that we have, and you just referred to it, is that the weakness of sterling is contributing to inflationary pressures as well. And if you look back at the experience of oil prices, and one reason why we're now facing a £2 a litre diesel price is because the pound has slipped down to 120 something. And it's not long ago that we were at 140. So we are making our problem more serious by the fact that sterling is weak. And I think in part that is weak because of the perception that rates will not rise as much here as they're going to rise in the US.
Sir Howard, you rightly call out central banks for openly claiming that they can't tame inflation, but in reality, they can. I mean, they have a blunt tool. They can raise rates, choke demand, and drive an economy into recession. My question for you is there any way that central banks can do that without driving an economy into recession? Are there other policy tools at their disposal, or perhaps it's not providing as much forward transparency? I'm curious to hear your thoughts on that.
Yeah, I think what's one got to look at is the time dimension here. And obviously, if you get a very sharp exogenous shock, like an oil price increase on the sort we've had and the war, then you can't expect central banks to deal with that instantly. But in fact, the inflation target formula explicitly recognizes that. And inflation targeting is meant to target an inflation rate at 18 months, 2 years ahead. So I think whereas I can accept the central bank saying, look, we can't respond to this immediate spike, that's fine, that's understood. But what they must do is present a plausible path of interest rates, which is going to deliver them back to the inflation target in 18 months to 2 years' time. And that's why I think you need a higher rate at the moment in order to give credibility to this medium-term inflation outlook. And I don't think that's where we are at the moment, unfortunately, in the UK.
Well, Sir Howard, let's tear up the script a bit. You've been a member of the International Advisory Council for the China Securities Regulatory Commission since 2003. There's about 200 China listings on U.S. exchanges, I think roughly 1.7 trillion in assets. With all that's going on, with the lack of transparency with the PCAOB, I'm just curious to hear your thoughts on that. I mean, what is China's approach to all this? Do you think companies like Baidu, JD, I mean, are they going to avoid having to delist in the near term?
Well, the Chinese approach is evidently changing. Up to now, the CSRC, the Chinese equivalent of the SEC, if you like, has had a general policy orientation towards opening up Chinese markets. They've established a link between Shanghai and Hong Kong, a link between Shanghai and London, and that's been the direction of travel. Now, there are, however, signs recently, as you say, of the Chinese wishing to pull back because they're unhappy about the influence that external regulators have via a Chinese company listing in other markets. I think it's very difficult to say at the moment where this is going to go. And of course, for the last 2 years, COVID has got in the way of direct connections. I remain on that advisory council. In fact, I'm chair of it, but we haven't actually had a physical face-to-face meeting, and it's in the face-to-face meetings where you really understand what's going on. So I'm not trying to avoid your question, but it's honestly quite difficult to answer in circumstances where you haven't actually met people for well over 2 years now.
Sir Howard, before we let you go, do you think that the pound is ever going to get above that 145 mark versus the dollar that we saw pre-Brexit?
Unlikely would be my guess. I can't quite see why. There are the short-term issues we've been talking about involving interest rates, but also in the longer term, we do have a structural trade deficit, and that's been offset by capital flows for a long period of time. But, you can only sell the London property market once externally, net, if you see what I mean. They can trade it amongst themselves, you can only sell it once. So I don't see quite what is going to push the pound up.